All right, let's talk about 8x8, ticker EGHT, because their last earnings report was a real head-scratcher. At first, we're going to break down what happened and, more importantly, why the market did a complete 180 on this stock in less than 24 hours. So here's the big question, right? You see a stock dip 3.5% after hours, and then the next morning, bam, it rockets up 47%. What on earth happened overnight? What did the market suddenly figure out? That's exactly what we're going to unpack. Okay, so to get to the bottom of this, we've got to start where everyone else did, with the headline numbers. And honestly, at first glance, everything looked pretty good. So you can see here 8x8 beat expectations across the board. The street was looking for 9 cents a share in non-GAAP earnings. They delivered 12. And on revenue, they came in more than $5 million over the estimate. I mean, that's a solid, clean beat. No two ways about it. And that 12 cents per share number, that's a really big deal. It tells you that management's promises about focusing on profitability aren't just talk. They're actually doing it, they're controlling costs, and that discipline is flowing straight down to the bottom line. But then you look at revenue growth. Just 3.4% year over year. Now that's not bad, it's growth, but it's not exactly setting the world on fire, right? And this, right here, is probably what those initial trading algorithms saw. It's solid, but it doesn't scream, buy this stock up 47%. This is where things start to get interesting. So if the headline numbers were just okay, what caused that massive rally? Well, for that, you have to dig deeper. You have to go past the press release and listen to what management was actually saying on the earnings call. That's where the real story was hiding. And the CEO, Samuel Wilson, he basically gave everyone the clue. He talked about momentum, but the magic words were these: usage-based revenue is scaling rapidly. That's the phrase that probably had analysts across Wall Street pausing the recording and digging in. And what they found was this number: 60%. This is what changed the entire narrative. We're talking 60% year-over-year growth in the stuff that really matters. They're high-margin, usage-based products. Things like AI and their communications platform. All of a sudden, you realize this isn't a sleepy 3% growth company. There's a rocket engine strapped to this thing, and it's starting to fire. And this wasn't some one-time fluke either. I mean, look at the drivers behind it. That high-growth part of the business, it's now more than 20% of their total service revenue. The number of voice AI interactions just exploded, up over 200%. They finally got the messy Fuse migration done, which is a huge operational win. And get this, even with all that AI, their number of contact center seats actually went up. That's fantastic. Okay, so when you have that kind of momentum bubbling just under the surface, what do you do as a management team? You don't just sit on it, you get confident. And that's exactly what happened. They raised their guidance for the future, which is the ultimate signal to investors that things are going really well. And we're not talking about a little bump either. This was a significant raise. They upped their full-year revenue outlook by about $12.5 million and jacked up the earnings guidance from around 31 cents to 36 cents. That's a team basically shouting from the rooftops, hey, that great quarter we just had, it wasn't a fluke. This is the new reality. Now, it wasn't all sunshine and roses. There was one little yellow flag, one known issue they still had to deal with. But what's really important here is how management handled it. They were totally upfront about it, and that transparency, ironically, is probably what made investors trust the good news even more. So that headwind was the last little bit of customer churn from shutting down their old Fuse platform. But here's what they did right. They didn't try to sweep it under the rug. They put numbers on it. They told everyone exactly when the impact would be worst and when it will be over. And they even said that despite this headwind, they still expect to grow next year. What that does is it takes a big, scary question mark and turns it into a known, manageable problem. Okay, so let's put it all together. You've got a solid beat on the top and bottom line. You've got this hidden growth engine absolutely firing on all cylinders. You've got management raising guidance, and you have them taking their one big risk and putting it in a neat little box. That's the recipe for the market to wake up and completely rethink what this company is worth. And this timeline just lays it all out perfectly. First, the algos, the machines. They see the 3% growth and they sell. That's the initial after-hours dip. But then, overnight, the humans take over. They actually read the report. They listen to the call. They do the work. They find this 60% growth story. They understand the guidance. And the next morning, the real money shows up, and the stock gets a complete fundamental reevaluation on massive volume. So that's the story of the crazy 24 hours.
But the big question now is what happens next? Now that the market gets it, where does the stock go from here? So let's talk about our outlook and what we're thinking for the next call. So here's our thesis. We think this momentum is real, and we expect 88 to meet or maybe even beat the high end of that new higher guidance they just set. That 47% jump wasn't just a fluke. It wasn't a short squeeze. It was the market waking up and changing its mind. AGHT is no longer a show-me transition story. The narrative has now shifted to profitable acceleration, and it's all being driven by that high-growth, usage-based model.
And because of that fundamental shift in the story, from a turnaround to a real growth accelerator, we're initiating our view on the stock with an outperform rating.
And of course, just a reminder, this is not financial advice.